Hello, everybody. Thank you for joining. My name's Reuben. I'm co-founder and director of CityRise, and I'm joined here today with Matthew.
Head of People and Performance, and looking forward to my first webinar with Reuben.
Cool. So, we're going to talk today about rental yield versus return on cash invested, what they are, why they're different, when you should and shouldn't be using them, and then talk a bit about kind of how to leverage and expand your portfolio as quickly as possible. So Matt's going to be asking the questions. I have a little bit of an idea of what he's going to ask. Some of the questions I don't know, so he might try and catch me out a little bit.
Maybe.
But I'll answer them as best as I can. I think he's going to start off just kind of being as nice as possible, and I can explain things nice and clearly. Then we'll get a little bit more technical as we go deeper in. Is that about right?
By me, yeah.
Cool.
So let's start off with what actually is yield and how is it calculated?
Yep. So yield in terms of property is just a very simple calculation. It is your annual rent divided by the purchase price of the property.
Brilliant. And would you say that yield is the key metric that you should be looking at when considering investing in property?
No, essentially. There is another metric which we're here to talk about, which I think is far more important for investors. So yeah, we can kind of talk about that.
The reason I asked that is because it's what most agents talk about.
Yes.
Why is that?
Yeah, sure. So there's a very good reason for that. Now, an agent has the purchase price of the property and they know what the rent's going to be on the property. So they're using the fixed figures which apply to everybody. However, as a buyer comes involved, there is a lot more variable costs. For example, Matt, you might have a different mortgage rate to Joe Bloggs. Yeah. Or you might be putting in a different level of deposit to Joe Bloggs. So at that point, the costs become the figures become variable. So an agent can give the fixed numbers, which can give a blanket kind of yield, which is good for everyone to be able to see from a high level.
Understood. So in your very experienced opinion, what metrics should investors be looking at and considering?
Yeah, it's called ROCI, which is return on cash invested. And that is very different to a yield. I say very different. It has some similarities, but the outcome is different and a lot more accurate for investment purposes.
Okay, so for the purpose of everybody, could you just break down exactly what return on cash invested is and how you would calculate that return?
Yeah, sure. So typically return on cash invested is used when we're looking at buying with a mortgage.
Yeah.
As we're looking at the deposit level.
Yeah.
Obviously, if you're buying with a mortgage, you're going to have mortgage costs monthly, annually. So we need to look at then your net rent after mortgage costs and then divide that by the cash that you're putting in, typically a 25% deposit. Okay. So that's going to give a much more accurate idea of how well your money is working for you.
Yeah.
As opposed to having your money in the bank, having it in stocks, shares, crypto, whatever that might be. You're getting a true comparison to how well that capital is working for you.
Okay, so if you're buying a property using cash, no mortgage,
yeah,
yield and ROCI are the same?
Yes.
Okay.
So obviously, if you're buying the property cash outright, then your figures are going to be the same as the yield because the purchase price is the same as the amount of cash that you're putting in. But typically, most people are buying with mortgages. And if you're not, I'll talk to you a bit about why you should be.
Okay.
And yeah, I think a lot of investors will make decisions on properties based on the yield, and that's just really not what they should do.
Okay. Why is return on cash more important than yield to most, not all, to most investors?
Yeah, for a couple of reasons I just mentioned really, which just, it gives you a very clear understanding of how well your money is working for you as opposed to other investments or savings accounts that you might have it in, whereas your yield is not giving you that representation. I always say yield is how well the property is performing.
Yeah.
Return on cash invested is how well your money is performing, and the two are different.
Okay, thank you. Why does using a mortgage increase the return on cash invested?
Yeah, simple maths really. Obviously, if you're using a mortgage, you're going to be putting in a lot less money, hopefully, typically 25%. So yeah, obviously your percentage return should increase. Yes, we're going to have to take out some expenditure for the mortgage costs, but if we do some, maybe we do some examples and I can show you how that kind of works against each other.
Well, funnily enough, Reuben, that was going to be my next question.
Okay.
Please, could you give us an example of a property purchase and explain the yield and the ROCI when using a mortgage?
Yep, sure. Okay, so for numbers' sake then, let's say we have a property priced at £200,000.
Okay.
Okay, so let's say the rent is £10,000 a year.
Yeah.
Okay. So we would do £10,000 divided by the purchase price, £200,000. We then times it by 100. That gives us 5%.
Yeah.
So the yield on this property is 5%. Okay.
Okay.
If we were buying that same property, but on a mortgage, we'd be putting in a 25% deposit, which is 50,000. Okay.
Yeah.
Let's say our annual mortgage cost is £6,000. Okay. The rent was 10,000. The annual mortgage cost is 6,000. That gives us a net rent of 4,000. Okay. Yeah. So now we want to be dividing our net rent, not by the purchase price, but by the cash that you're putting in.
Okay.
So by the £50,000 deposit, that then gives us 8%. So the return on cash invested is 8%. You are getting an 8% return from the rent on this property.
Understood.
Okay?
Understood. Okay. So if buying with a mortgage increases the return on cash invested, right?
Yes.
So
Obviously, that is dependent on the mortgage rate.
Yeah.
If you've got a 20% mortgage rate, that might not be the case.
Yeah. Okay.
But in the market at the moment, and typically mortgage rates are floating on the higher side, or at least higher than they have been, and certainly in COVID times. We are at the higher end of mortgage interest rates at the moment, and typically on those kind of 4 to 5% interest rates, it should work out better buying with a mortgage than buying cash. Okay.
So would you say all investors should buy with a mortgage?
I think in the current market, if you can buy with a mortgage, if you're eligible for a mortgage, then yeah, absolutely. I think there's sometimes people have a bit of a stigma of they don't want any debt, they don't want a mortgage. But I say there's good debt and there's bad debt. And a good debt is any debt that you're using to make more money, to increase cash flow, to increase returns. So buying a rental property, not necessarily a property for yourself to live in, that's more of a liability. Yeah. But any property you're buying that has positive cash flow is a good debt. So yeah, absolutely.
Brilliant, thank you. Would you say there's any other benefits to buying with a mortgage?
Absolutely. It means you can split your cash.
Yeah.
And make it work better for you in terms of hopefully buying more properties, depending on obviously how much cash you've got. But it just means instead of putting it all into one, you can split that and buy multiple, which obviously comes with much more benefits as well.
Understood. I'm going to put you to the test a little bit here then.
Okay.
So what I'd like you to do is map out for us all the overall return on an investment, including the capital growth.
Okay.
On a property value as well.
Yeah, sure. Yeah. Okay, fine. I also would like to say, if there's any people watching who are saying, well, if you're buying with a mortgage, you're going to have extra costs like your mortgage broker costs, and you haven't mentioned stamp duty and What about lettings and management? Just for the purpose of this, I'm just keeping it very simple, just to keep the numbers easy. But yeah, obviously, if you're going to be crunching numbers on an investment, you want to be looking at every single cost that is involved.
I'd probably say if someone does want more information on that, contact us.
Yeah.
And we'll go through absolutely everything. So let me ask you the question again then.
Yeah.
So how do we work out the overall return on an investment, including the capital growth on the property values?
So let's use the same example of the purchase price, £200,000.
Yeah.
Same rent, £10,000 a year, which gave us a yield of 5%.
Yeah.
So if we want to include capital growth, we want to be, let's say property prices are going up went up 5% in the year. Okay, so property's worth 200k. After a year, it's worth 210k.
Yeah.
Okay, so if I was buying it cash, it'd be the property price is the property value is now worth 210,000. If I'm buying it with a mortgage, still the same. You're still making the same equity from buying with a mortgage. So my property is worth £210,000 after 12 months. Okay. Now, what we need to do is add that £10,000 onto our net rent return. So if I'm buying with a mortgage, we said that was £4,000 a year.
Correct.
We add our capital growth, our equity, onto that, which is 10,000. So we're getting £14,000 per annum return.
Yeah.
If we're buying with a mortgage, we're putting in 50k. So the calculation is simple. It's your annual return divided by cash that you've put in. So it's going to be £14,000 divided by £50,000 that you put in. And that gives us a return of 28%.
Pretty good.
So yeah, I think that just shows the importance of running these numbers. And it's important to say that, look, property prices aren't guaranteed to go up by 5%. No. But if you can get 8% return on your cash invested, that's very competitive compared to, if you know what you're doing in stocks and shares, yes, that is achievable, but it's volatile and you still need to know, you need to be investing in the right things.
Yeah.
So having that in bricks and mortar and getting 8% just on rent alone without any capital growth, for me, is great. And the capital growth, when that comes, which it usually does, if you hold it for long enough, then that's when you start really building, long-term wealth.
Brilliant. Thank you.
No problem.
Okay, so let's use a live example.
Okay.
Just for you to kind of go through that again. If I had, let's say, 200k today, how would you advise me to invest it?
Yeah.
And how would you advise me to invest it, and show us an example of what that would look like in terms of all the figures, if you can? Yeah,
fine. So if I had 200k to invest, I'd be looking to split that across 4 properties.
Okay.
I'm just going to do, again, for numbers' sake, just say we're putting £50,000 into each. Yeah. Okay. So let's say £50,000 per property. Okay. And we'll use the same numbers as we have done throughout.
I can help you with these.
So we had a net rent of 4,000 if we are buying with a mortgage. So we now have 4 properties, all giving us £4,000 a year.
So we have 16,000 in total.
So we have 16,000 net rent return in total. If I was buying that property with cash, Matt, what was the rent we were getting per annum?
£10,000.
And so with my 200k, I've either put it into one property and I'm getting £10,000 net rent.
Yeah.
Or I'm buying 4 properties with mortgages and I'm getting £16,000 monthly rent.
6,000.
So I'm getting 6,000 more, and we haven't looked at the capital growth element yet.
Okay.
So let's use the same capital growth example. If I put it into one property, I was getting £10,000 in equity. If I put it into 4 properties, I'm getting £40,000 if the market goes up by 5%.
Yeah.
So if I'm buying it cash, I'm getting 10,000 in capital growth and equity
Yeah.
and 10,000 in rent.
Yeah.
So after year one, I've made £20,000 off of my £200,000.
Brilliant.
Okay.
Really good.
Okay.
Yeah.
If I buy them with a mortgage,
Yeah.
I'm getting a 40,000 in equity, capital growth, plus my 16,000.
Yeah.
So I'm getting 56,000 return
Yeah.
from my £200,000.
Which is a lot more.
Yeah,
£36,000 more.
you know,
Really good.
way over double. You know, so what do you think is the better option?
I would have to say, Reuben, that it was splitting that money and buying as many properties as I could to increase the capital growth on more than one property. Pretty obvious.
Yeah, and I think, look, not everyone has £200,000 just to invest. But even if you've only got enough for one property, you know, you can, you know, a lot of our clients like to refinance after a few years after the property's gone up. But, you know, just being able to split into as many properties as you can is going to help build that rather than put it all into one. So, for example, if you had, you know, 70,000, you could probably find, you know, a terrace house in a not so great area somewhere and buy it cash, or you could split it and buy two properties.
Yeah.
So yeah, no matter what your circumstances, always try and leverage that money as best as you can to increase returns.
Great advice. Thank you, Reuben.
And I think all of our consultants here, one of the criteria is you have to have invested in property to work as an investment consultant here, which is really important for us. And they're all very well trained on these figures and how to work them out so they can help our investors with this. You know, not everyone is mathematically astute. Some people are and some people aren't. So, you know, if you are, that's great. This will all be very easy to you. If you're not, we can help. And we have some really, really good spreadsheets that our team have put together where you can literally just enter your purchase price, what your rent is, and it will just do pretty much all your calculations for you. So we can kind of share those as well.
I've seen them spending a considerable amount of time mapping out investment strategies for our investors, and not just for buying one now, but what that could look like in 3 years' time, 5 years' time. And the investors' feedback on that, on those strategies, are absolutely brilliant.
Yeah, that's it. And I think, you know, every investor has a different goal or reason why they're investing. Yes, they're investing to make money, but what's the reason for that? Is it to have more cash flow on a day-to-day basis? Is it for pension? Is it to pass down to your family, kids? So everyone's investing for, you know, emotionally a different reason. And that is going to depend on slightly on what strategy you go for to hit those kind of goals or requirements. So the team are very well versed in being able to put a strategy together, not just financially, but actually in terms of which properties to buy that are going to help you hit those goals. And yeah, they spend a lot of time to make sure they get that right.
Certainly do. Brilliant. Thank you.
Any other questions you wanted to fire at me, Matt, while we're here?
Do you want me to throw you a curveball?
Throw me a curveball.
This is something that, and I will add, this is not prepared, and Reuben has not had chance to answer this. I'm going to give you a real life example.
Okay.
So I've got some capital at the moment, and I could either put that into a stocks and shares ISA, or I could buy a property. Okay. Now, I'm naturally quite risk averse. I have had this money sat waiting to invest in something for probably 5 years. It's done absolutely nothing in the bank, and I think I'm quite a good example of a lot of people out there, you know, just hesitant, you know, what's going to happen with this, what's going to happen with that. Why should I put that capital into an investment property over leaving it in a stocks and shares ISA?
Okay, so my first question to you would be, what stopped you putting it into stocks and shares?
Because I'm very risk. Sorry, go on.
Yeah, because, yeah, okay.
Ask your question again, sorry. I was answering you before you finished.
I think I did ask it. So, yeah,
okay.
Just because you're risk averse.
Yeah, very risk averse.
Very risk averse. Okay. And have you kept track of what the stocks and shares have done over the last 5 years?
No.
Not really?
No.
Okay. Well, they've gone up and down a lot, depending on what people like Trump do. Have you seen what's happened to property over the last 5 years?
Yeah, always on my own property.
Okay. Has it gone up?
Yes.
Okay. So if you'd invested it 5 years ago, would you be in a better position now than if you'd left it in the bank?
Yes.
Okay. So, I mean, do I need to say any more?
No. Well answered. And that, promise you, that wasn't a planned question.
It wasn't.
And that is a real life situation. So well answered, Reuben.
No worries.
Thank you.
Cool.
That's it from
Any
me.
questions from the guys?
Not today.
No. All right. Cool. Yeah, that was quite quick fire, but hopefully it was kind of to the point and valuable. But yeah, please do get in touch if you want any more information on that.
Thank you.